Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis, Thursday, March 19, 2015. Inside the numbers tonight is we're going to talk a little bit about how to beat the casino. We're going to talk about the Spider and the E-mini contract. We'll talk about crude oil. We'll do gold. We'll talk about interest rates in the bond market, and we'll finish with the Dixie. Okay, so let's go over to WYNN Resorts. Okay, this is how you beat a casino, because playing blackjack or craps or slots or any of that other nonsense, you can't win, or at least I can't win. Anyway, so yesterday a trade alert went out to members. This is an hourly chart. Trade alert went out to members. The stock was trading beneath 122. Okay, right here. All right, so that was yesterday before the market rallied up, and WYNN did rally a little bit yesterday, but today was the big day. And today, WYNN was up over $7, okay? In fact, in the aftermarket, it finished up $7.56 in total. So let's look at the daily chart, all right? And here we go. Now, mind you, today was a down day in the market, and WYNN was up $7 over 5%. Okay, so this is a one-day deal. All the members that got the trade right now should have a trailing stop in place, at worst case break even, but probably in the money at this point, and just let it go. Okay, when a stock moves like this, it means there's institutional buying behind it, and it also means that it's probably going higher. You can get some pause days, you'll get some backing and filling, but ultimately the stock is going to want to go higher, and since we know the market's going to be bullish, okay, in the coming weeks and months, okay, WYNN's going to take the ride with the market also. So those of you that bought it down at 122, great, and just let it ride and let it rip. Okay, let's go over to the Spider contract, and today was a down day in the market, and it's not that unusual after a big, huge up day following the Fed announcement. It's not that abnormal to put in somewhat of a pause day. In fact, let's go over to the hourly chart, and let me just show you the level in which we really came today, just to show you it's not out of the ordinary. So if you look at the Fibonacci levels, okay, right here, all right, you came into a little more than, let's say, about the 25% retracement, okay, and it's not out of the question to get down to the 382 maybe tomorrow, and that would be a good level, because look at what you have here. You have a pivot high, okay, and you have these pivots here, which is going to tell you that there's a lot of support in the market. So if the Spider comes down to the 208.65, pierces it a little bit, let's call it 208.50. 208.50 is going to be a lot of support, and then even more support will be 208, okay? Maybe 207.84 if you want to go for the 50% retracement. But that doesn't take away the big up move, and it doesn't take away the bullish nature of the market. Let me go over to the E-mini contract a second, because the way I read the E-mini is just slightly different, because I do my calculations on the E-mini, and 2071, if you remember that number from the other day, that was the number that the market would turn bullish above it and remain bearish below it. Well, I put that line in here because this is the 60-minute. Let's go to the daily. I put that line in because it's still a very important number. So as long as we're above 2071, the market's in a bullish position. Below 2071, and the E-mini and all the other related markets will become in a bearish position. So that's very important. So this gives you a target to trade around. Now, when I say get above or below, first we look for hourly closes. So if we came into this level, 2071, and we began to close hourly below that level and then close the day below that level, that's negative. That's going to be bearish for the market. As long as we remain above that level hourly and daily, it's bullish for the market. And that's the that should be a good enough picture for you to get a good idea of which direction the major market is headed. What else do I have in my notes here on the market? I do I do want to make mention of the IWM because even in a down market today, okay, the S&P was down 0.5%, the Dow was down more than 0.5%, the Nasdaq was flat, it was up 10 points, but the IWM was also up. And what that tells us, 1/3%, but it was up nonetheless, or 1/4%, but nonetheless it was up. That tells you that there's buoyancy underneath this market. There's a bullish nature of the market because people are buying, institutions are buying, money is flowing into the riskier assets. When that happens, that's of a bullish nature. The other things you want to pay attention to, remember it's quadruple witching options expiration tomorrow. Tomorrow is also the spring equinox, the vernal equinox. It normally signifies a trend change, not just in markets, but trend change in lots other parts of our lives. And we also have a solar eclipse early in the morning, but I don't know if that will affect our markets or it won't. It's almost like a push, like 50-50, whether the market goes down or up in an eclipse. Maybe it's slightly leaning downward, but it doesn't necessarily mean much at this point, I don't think. I'm not concerned about the eclipse. Okay, so gold. Let's go to gold. Gold put in a, this is GLD, put in basically a flat day today. It was up a few pennies at the end of the day, but it's pretty good. We still have to, let me draw that trend line in from last night again. We have to, maybe I drew it in on the other chart, in the gold chart, but either way, we have to get above on a closing basis. Did I draw it in on the actual gold futures chart? Yeah, we have to get above, close above this trend line in order for the market to really take off, okay? If it does not, all right, same thing goes for GLD. There's no difference here in the markets. It's the same line, it's the same market. So as long as it gets above this trend line, okay, with, conviction, meaning a couple of closes above it on a daily basis, then we can have upside to the 50-period moving average as far as the 200, and on a higher shot, we might even pierce 120 on the GLD. So that's what's in store. But if it does not, and let's go back to the other chart because I have both trend lines built in. If it does not get above this trend line, then we're going back to the bottom of the trend line, and by the time we get there, it's going to be much lower prices. And remember, the line in the sand is 1145. 1145 above is bullish, below is bearish. That number still stands right now, so keep that in mind. Let's go to, I know some people like to follow the GDX, so I know from time to time I'll try and remember to do the GDX. Same deal with the GDX. It's not the same trend line or anything like that, but the good news here is you got above this high here, okay? However, in order for the GDX to really take off, you need to get above the 20-period moving average, above this level here. And if you do, you'll take a run at the 50 and then the 200 up at $22, maybe even this double top here. That's a nice move in the GDX. And right now, you can trade it pretty much against even this low here, which is 1771. So you can trade GDX on a close below 1771 on a daily chart close. You stop out. As long as it's above that level, you can trade it from the long side, the upside. All right, let's go over to interest rates in the bond market. Let's see. Let's go to the TLT. And we know our level on TLT. We're long TLT. I think there's more upside here. We whipped around a little bit, but went really up high after the Fed announcement. And what this is telling us, it's the bond market is telling us that money is flowing into the bond market because they feel rates are going to stay, remain, or go lower from here. Okay, and I think it's all three of them. So if that is the case, then you could get all the way up to 135 in the TLT. Okay, that's four more points in the TLT. We started at 124 and a quarter. Okay, that would be some trade in the bond market. People wait a year to get 2-3% return in the bond market, and we're getting it all in one shot and then some. So that's where we stand here. If you just want to flip over and look at the yields, what this means is that you can see yields back down in the 180 neighborhood. I would expect yields to find some support at this low at 1805 or 1.80 for the most part. And that's significantly lower than we are on a percentage basis right now. So interesting. People are always talking about higher interest rates, and that is coming. In fact, let's talk about that for a second. That is coming much later, though. If you go over to the monthly chart, you'll remember that we had this big down month, okay, in February. Okay, now we're going to probably work off that big down month for a few months, go sideways, maybe challenge the high at some point. Okay, but make no mistake about it, my work tells me we're not going anywhere past the high here of 138.50 on the TLT on a monthly close. So you know what you can trade against there as well. So you know your range right now, and there's probably more upside in the TLT. All right, let's flip over to the dollar and we'll give it a wrap. Here's the dollar chart. And here we'll start with the monthly, and look what happened. We came right up to the underside of this trend line, or right to that trend line today. Okay, that's interesting. So we spiked above it. We sold off pretty good yesterday. In fact, we had this interesting number printed yesterday. I think it was right after the close, and either around or right after the close. Down here at 94,765. Okay, that's down there. And what's interesting is it only was down there for, and I looked at the 1 minute chart. It took like I think 4 or 5 minutes to get down there, and it spent less than a minute down there and then rocketed back up. But I'm not convinced we're just going to see higher prices once again in the dollar right away. And I would love to buy the dollar. I would probably start to buy a position here, and then I would buy it anywhere in this zone down here, and I would certainly buy it with 3 hands down at this lower trend line here. But the dollar's something you want to be long for 2015. So any opportunity you have to buy the dollar, I would take advantage of that. And why is it important? Because as the dollar moves higher, you know what? Did I skip oil? I might have skipped oil. I did. Sorry, folks. Okay, let's go over to oil. So oil had a down day today after yesterday's big up day, and if you remember, this is the USO. If you remember, I said our best case right now is to get to the bottom of this channel here, or this trend line here. Well, we're nowhere near that now, and it's going to take some work to get there. And remember the number, 44, below 44, and this is the April contract. We're going to be flipping over, so I'll have a new number. But 44 right now is the line in the sand. It's the Mendoza line. Below 44 is bearish, above 44 is bullish, but you're going to have trouble getting through or into this channel one last time. So we'll see what happens. But let's go back to the dollar. And the reason why the dollar is important is because all commodities are priced in dollars. So if you have a stronger dollar, you lower commodity prices because you're able to buy less with less product with a stronger dollar. It drives the price down. It's supply and demand. So if the dollar is going to continue to move up, I would expect oil and other commodities to move down. Now, then you would say, well, what about gold? I don't necessarily believe gold, like other people do, that gold is directly tied to the dollar. In fact, I don't believe any market is tied to any other market. But in generally speaking, a strong dollar does have a long-lasting, weaker effect on commodities. Not necessarily day by day or even week by week, but overall it does put downward pressure on a lot of the commodities, specifically oil. And that's what's been happening of late anyway. All right, I know this video is long in the tooth. Let's give it a wrap. Hopefully it's been helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.